Have you ever gone through the pre-approval process or had a friend and they were excited about buying their first home and knew that they were going to start searching for their condo, and they got through the process of going through negotiations to get an offer accepted, and then come to find out their loan is not approved because of the HOA, even though the credit looks good, income is solid, and the down payment funds were more than enough? Maybe you're just starting to explore condos and you keep hearing that they're harder to finance, whether that's from a friend that had their horror story or even the realtor you might be working with. But no one has actually explained why. That confusion alone can stop a lot of buyers from even moving forward in their home buying process when they know that they can only qualify for a condo right now in the market that they're looking at. Or it can just cost a lot of time for a buyer if they're already under contract. So today, we're going to break down why condo loans are different and what you need to understand before you buy one. My name is Amber Jones. I'm a certified mortgage advisor, and I'm here to help inform you, empower you, and help you solve that financial obstacle that you're currently facing wherever you're at on your homeownership journey. Let's dive into it. Now, when most buyers think about getting approved for a mortgage, they assume that the approval is all about them, their income, their credit, and where their down payment and closing costs funds are going to come from. Is it going to be that family member? Can we actually get the help? Or what's it going to take to get those funds from my 401k and all the other things that are part of bringing the loan together? Now, while all of that is important during the pre-approval process, the pre-approval versus the actual loan approval during the home buying process is different because the pre-approval is just approving the person as a borrower, their income, their credit, the assets available. But during the loan process, there's two parts of the approval that we have to get through. Yes, it's the borrower, but it's also the property. So whether you're looking at a condo or a single family home, we still have to also make sure that the property meets the lending guidelines as well. Now, with a condo, the lender is looking at two things in regard to the property. So not just the structure itself, but also the HOA, or the homeowner association. The HOA is reviewed for things like financial health and reserves, so the spending and the budget of the homeowner association, as well as the insurance coverages. So they have insurance coverages for the building itself and whether or not they're going to insure the inside of each of the units, or if that's going to be your responsibility. And then whether or not there's any pending or active litigation against the association, and if there's any special assessments. So if the HOA doesn't meet certain lending guidelines, then it can limit the loan program that's available, or it can just stop financing altogether, even if the buyer themselves are a very strong borrower. So this is where terms like warrantable or non-warrantable come into play, or if the complex is FHA approved or VA approved. An important point is that most buyers don't often hear that the condo is labeled as non-warrantable. But a condo being non-warrantable doesn't mean that you automatically can't buy it. What it means is that the loan strategy is what's going to be important. Non-warrantable specifically means that on a conventional loan, it doesn't meet Fannie or Freddie guidelines for one reason or another. But that doesn't necessarily take away the ability to still purchase within that non-warrantable complex using an FHA or a VA loan. But there's some cases where a conventional or a government loan won't work at all, and we have to have an alternative financing solution. So these are specifically called non-warrantable condo loans. They require higher down payments, also stronger credit scores, and in most cases, at least 3 to 6 months in reserves after you close. So problems can arise during the home buying process when the pre-approval is a little too generic. And then the buyer falls in love with a particular unit, but then finds out that the HOA creates restrictions that they just weren't prepared for. That's when the deal starts to fall apart, and buyers can feel like condos are just too risky or too challenging, when really they just didn't have the right guidance early on. The truth is, condos can be a powerful stepping stone into homeownership, especially in higher cost markets. But they require planning upfront, not reacting later. And I know this because my very first home that we purchased was a condo. So, if you're ready to explore what options are available for your specific situation, I would love to talk with you. You can use my booking link below to schedule a 15-minute phone call with me. And during our time together, we're going to go over all of the questions you have, any of those concerns that you might have, specifically if it's for a condo, and then we'll start planning your next steps. I hope you found this information helpful today. And if you did, I would love it if you liked the video, subscribed, but most importantly, share it with a friend. I hope you have an amazing rest of your day, and I'll see you again next time. Bye-bye.